Hey everybody, welcome back to the Optometry Money Podcast. We're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner practitioner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time and your attention today. And on today's episode, I want to walk through the top investing mistakes I see optometrists make as they come to my firm, as they want to get advice and management over all aspects of their finances. I want to talk about the most common mistakes I see as I look through new families' investments and start to create a game plan of how to improve it. These mistakes, or maybe better said, areas of improvement, these opportunities of improvement, come up time and time again, and they can quietly cost you over your lifetime, over your career. And so I want to talk through those common areas of improvements with families' investments and how we might approach improving that. So let's go ahead and dive right in. Mistake number one is not having a clear investment approach. Many families that I see come to me with sort of a junk drawer portfolio. And this is very often when they've been handling the investments themselves. And what I mean by that is it's just a random collection of funds kind of thrown together without any sort of unifying plan. And one account may have a target date fund. Another account may have a different year's target date fund. There might be index funds in another account and maybe some random industrial or commodities fund in another. There's really no rhyme or reason of why the certain funds are picked. It's just sort of a random collection over the years. And without a strategy, you're not really investing. You're just sort of collecting products. And so where I like to start, and this is probably the easiest thing to address and to improve on, where I like to start is to create a clear investment approach. And if you've listened to some of my past episodes on investing, which I'll throw into the show notes, I want to start with a clear investment approach of how we're going to handle the investments. What you hear in earlier episodes is that I believe, based on the evidence and research we have available to us, that a passive style of investing makes sense, meaning investing not based on a manager's intuition or my own intuition and trying to select the individual investments I feel will do better, or trying to time swings in markets. I think the better approach is to invest broadly, in a broadly diversified way, based on a clear, transparent set of rules, and trying to minimize costs and taxes where we can. And one example of this is index fund investing. I have an episode all about the merits and research behind why index investing makes sense. But I also consider factor-based investing to be a part of that as well, having rules that tilt towards certain characteristics like smaller companies and cheaper or value companies and more profitable companies relative to the index as a whole. And so I want to start with a clear approach. What is our approach to investing as a whole? And then we go through the process of figuring out, okay, based on where your family's at in your career, based on the goals that you're investing toward, your time horizon before you need to use the funds, what is the right mix of stocks versus other things like bonds that make sense for you? And then knowing our approach, knowing that mix that my firm is targeting and maybe you're targeting as well, then we can start to say, okay, which funds do we use? Which investments do we use to fill those categories? Stocks versus bonds, US versus international stocks, large versus small, and different characteristics. So you start with an approach that makes sense, an overarching approach that is evidence-based. You narrow down into the right mix of different categories that make sense for you. And then that leads to using the right products, the right mutual funds or ETFs. And all of your accounts should be managed together. I look at all of a client's household accounts that are going towards the same investment goal, retirement, for example, or financial independence, as one big household investment pie. And each account is a different slice of that pie, but I want to invest all of the different accounts together in a unified plan. And rather than having sort of a random mix of investments and funds and individual stocks and all these different accounts. And so not having a clear investment approach or a clear reason why certain funds are selected over the years is area of improvement number one, mistake number one. And maybe one of the biggest symptoms of not having a clear plan is this next mistake, which is thinking you are diversified broadly when you're really not. And so mistake number two is a lack of broad enough diversification. And what is diversification? It's spreading out your investment dollars across as many unique sources of risk and return as possible, so that if one risk shows up in your investments, for example, if one corporation goes belly up, well, that doesn't impact all of your invested dollars because you are broadly invested. And it's really a measure, it's really a way to manage risk in your investments. And so rather than invest in only one company, one corporate stock, you can invest in all of the companies in that industry. And instead of all of your wealth being tied to the performance or lack thereof of one industry, you can invest in all industries. And so you can start to go and build out and spread from there, including US and international. Sometimes this shows up as a client, as a family, as an optometrist holding too many of individual companies and not really having broad diversification. Other times I see this show up where the family will own a lot of like industry or trend specific index funds, kind of thinking, hey, it's an index fund. Like, shouldn't I be broadly diversified? Like healthcare, for example, or industrial or defense index fund or something like that. But they're really just concentrated bets on that one industry. So that's another way that shows up, is really concentrated bets on certain industry specific index funds. But more often, it's really that they own a bunch of funds, mutual funds or ETFs, that really own the same thing. So for example, and this is the most common example, is you might own a bunch of mutual funds, 5, 6, 7, 8 mutual funds, but they really all own large US companies, large US stocks. It's probably the most common thing I see is they own a few different funds. They could all be index funds too, but really when you look at what's inside of them, they're all just US large corporations. And as I've talked about in other episodes, for me, the starting point, true diversification and just common sense starts with investing globally, with the global market. And that's where we start our approach and our due diligence. And if we feel like we need to adjust away from that, if we have evidence that tells us to do that, we'll adjust from the global market. And so that's our starting point. And I think that should be the starting point for your due diligence as well. And so when I see a bunch of funds that all own the same large US corporations, I would say that is under-diversified. And there's a common misconception that if you own more funds, that should mean you're more broadly invested. And it's not necessarily about the amount of funds you own. It's really more about what's inside of those funds, what's underneath. And as you add it all together, is there a whole bunch of overlap, or is it really actually diversified? And so a lack of diversification, having a bunch of funds that really invest in the same stuff, is mistake number two. Mistake number three is something I see more often where the family's coming from another, let's just say XYZ large financial institution. But the second one is complexity for complexity's sake. Having far too much complexity in the accounts of the optometrist. And this shows up in two really common ways that I see. Number one is having a huge list of funds unnecessarily. And very often when I look at an account statement, and there are 10 to 20 funds, mutual funds, ETFs in this single account. And if that same family has multiple accounts with this institution, there could be a Roth IRA, a traditional IRA, a taxable brokerage account. They all have roughly the same boilerplate templated list of 15 to 20 accounts or 15 to 20 funds in each of these separate accounts. So when you add them all together, we're talking about 30 and more funds to deal with as a whole. And there's often a ton of overlap in between, very often with really highly active mutual funds that are very expensive and often tax inefficient. And it's just unnecessary complexity because very often you can replicate the investment mix underneath all of them. I mean, if you looked at what what was actually under the hood of all these funds, add it all up together. Let's just say it's 80% stocks, 20% bonds, and X amount to US versus international. Like when you actually look at what's underneath, you can replicate that same mix very often with far fewer funds and far fewer complexities, and very often with lower cost. You can often replicate with 3 to 5 funds, for example, or in some cases, if it's all stocks, with one fund. And so very often there's far too many funds in these accounts, even with really small dollar amounts, which seems to me like just complexity for the sake of complexity, or complexity is job security. And very often it's unnecessary. You can simplify the mix of funds, still get the same underlying mix of investment categories, and very often at a lower cost. It makes it difficult, especially where taxable investments are involved. It makes it difficult to unwind because you have capital gains to consider across a whole bunch of different investments. It's very easy with retirement accounts because there are no tax consequences to selling and reinvesting, but it's those taxable accounts where it starts to get annoyingly complicated to unwind. And so that's number one. That's area number one where I see complexity come in, with really long lists of often boilerplate funds selected, and very often expensive actively managed funds at that. The second way I see this come in is from the products themselves, meaning there are overly complicated products being used with the client. So that could be interval funds or buffered ETFs, for example. It could be things like indexed universal life policies or indexed annuities. It could also be things like private investments, like privately traded REITs or real estate syndicates. It could be different versions of alternatives or private equity. And when we ask the question, why are these investments there? What is the purpose of the investments? What goal or issue are these often high fee or high cost investments solving that you couldn't have solved with a simpler investment option? And very often when you start to peel back, like what is the real purpose or what issue or problem are they solving? There's not really a clear answer. And very often they're just sort of pitched to the investor because that's what investors with that size of investments are drawn toward. And what's frustrating is that very often they are sold or pitched with this sort of pitch that you can get market returns with lower risk, sometimes higher returns than something else with lower risk. And very often when you put that to scrutiny, very often those claims don't stand up to scrutiny. And even more, the complexity hides a lot of the fees sometimes and makes it difficult to evaluate them, and makes it difficult for you as an investor to have good expectations of what to expect. And so the products themselves or the things that are invested in are very often overly complex. And I've seen across a range of net worths, from very humble beginnings of the net worth side in early in the optometrist career to later in the optometrist career with multiple millions of dollars of net worth. You can invest wisely and successfully without unnecessary complexity. You don't have to layer on complexity as your net worth gets larger. You don't have to be drawn to things that are overly complex. You still can be successful as an investor and invest simply. And so whenever you are drawn to something or pitch something that is offering another layer of complexity, that is offering market returns with lower risk or something like that, I would look at those things with a healthy amount of skepticism. And I would ask yourself, you need to be very clear on what issue, what problem, or what goal is this particular thing solving that I wouldn't have solved without it. And a lot of times when you start to peel back the layers and apply some scrutiny, what you start to see is those claims often don't stand up, or you start to see that you just don't need the complexity in your life. And so mistake number 3 is complexity for the sake of complexity, overcomplicating the investment mixes and the investment options and products. And then number 4, the wrong investments in the wrong accounts. What do I mean by this? Well, if you look at all of your different investment accounts, you have different accounts with different tax characteristics. You might have pre-tax retirement accounts in 401ks and in traditional IRAs. You might have Roth retirement accounts in the 401k and Roth IRAs where the dollars are after tax, but assuming we follow the rules in retirement, we can draw from it tax-free. We might also have taxable brokerage accounts where the investment income that's kicked off from those accounts ends up on your tax return each and every year. And when we sell funds at a higher amount than we bought them for, we have to consider capital gains with potentially different tax rates. Or we might have HSAs, which have sort of a triple tax advantage where the dollars you put into it, federally speaking at least, are deductible. If you invest it, that investment growth doesn't end up on your federal tax return. And when you withdraw from it for qualifying healthcare expenses at any point throughout your life, it comes out tax-free as well. And so you have all these different accounts that hold investments, all have their different tax characteristics. And what we'd like to see are that we are putting the right investment categories in the right type of accounts, and we're matching them up from a tax and growth perspective. For example, we know that corporate bonds, treasuries, for example, those type of bonds kick off interest that's taxed at ordinary tax rates, just like your wages, just like your practice profit. So 12, 22, 24, 35%, so on and so forth. So that's really tax inefficient income. We'd like to see that not end up on your tax return. So with bonds, for example, we might look at bonds in your pre-tax retirement accounts, like the 401ks, traditional IRAs. Real estate investment trusts, REITs, funds that invest in REITs, we'd also like to see that income stay off of your tax return if possible. So we're looking at tax-advantaged accounts like retirement accounts as well. Roth IRAs, we'd like to see Roth IRAs hold the highest growth potential assets. We'd like to see that tax-free growth be as high as possible with our investment options. With stocks, on the other hand, stocks very often kick off qualified dividends, which are taxed at long-term capital gains rates, which could be 0%, 15%, 20%, depending on your income. And when you sell them, assuming you're selling these stock funds or the stocks themselves, assuming you've owned them for longer than a year, that capital gains are taxed at those capital gains rates. So those tend to be more tax efficient, and those are investments we're more comfortable holding in taxable investment accounts. And that isn't always the case with stocks. You're going to see some differences in the United States versus international. With international stocks, foreign countries may withhold taxes before they pay the dividends out, and you could potentially recoup that in a foreign tax credit if that's held in a taxable brokerage account. So there's some differences in United States stocks versus international stocks. And there are also differences too. If you are taking a really high yield income yield approach, like really high yield dividend funds or something like that, those are not tax efficient. You are forcing more dividend income onto your tax return by holding those in taxable brokerage accounts. And so, there are some considerations depending on the way that you are investing in stocks, but generally speaking, we'd prefer to see more tax efficient, broad-based index fund or factor-based stock funds inside of taxable brokerage accounts. And very often ETFs are more tax efficient just due to the way that they're structured than mutual funds. They tend to kick off less capital gains at the end of the year. And so we'll try to target ETFs versus mutual funds where possible. So those are some of the considerations. And again, the way we'd approach that is we look at all the client accounts, the family accounts going towards the same goal as one big family household investment mix. Each account is just a slice of that. And knowing the target percentages of different categories like stocks versus bonds and US versus international and all of that, we can look at all these accounts and say, well, which categories do I want to place in each account? And we'd buy those funds in that particular account. And we call that asset location, right? Just putting the right investments, the right assets in the right category of accounts. And that only works if you see everything together in harmony. It doesn't work if you look at all these, each separate account in its own silo. And very often what we see with the new family that we're working with is that we'll look at their accounts and we'll look at the statements, and each account is handled individually on its own in a silo. And we'll very often see with taxable brokerage accounts, inefficient investments. We'll see taxable bonds in those accounts. We'll see REITs in those accounts. We'll see high income dividend funds in those accounts. And we'll also see very active, very tax inefficient mutual funds in those accounts. And so very often those accounts are tax inefficient, kicking off more income onto your tax return each year than is necessary. And then even in terms of retirement accounts, we'll often see in Roth IRAs, for example, bond funds in those Roth IRAs where we would prefer not to see those. By looking at all of your accounts together, you can take a more efficient approach with where you place each category of investments. And even slight tax costs, if you look at those tax costs, even slight tax costs over several decades can have a pretty substantial impact on wealth over time. And so these are the four most common sort of areas of improvements that I see with client investments. Even though for the most part, clients aren't coming to us with concerns about the investments, it's very often things related to a cash flow in the household or in the practice. It's related to student loan planning. It's related to more proactive tax planning. It's wanting to see more progress towards goals like financial independence. So very often we're not really getting to the investments until, maybe 3 to 4 conversations in, but there's very often opportunities to improve the investments. And so these are some things you can think about as well. And if we were to think about next steps from here, what I would look at is I would think about for yourself, or if you're working with an advisor, what is our overall investment approach? What is our philosophy here? What is our targeted mix of stocks versus bonds? And then within things like stocks, US versus international, large versus small, growth versus value, and different things like that. What are our targets? And then once you have those things, you can start to say, okay, which funds do I want to use in order to fill those categories, those targets, and which accounts should I hold those in? And be careful about thinking that more funds automatically equals more diversification, and be careful about thinking that more complexity automatically leads to better outcomes. Very often, simplicity, lower cost can lead to better outcomes versus the alternative. Talk with your financial advisor about the investment approach that makes sense for you. Obviously, I cannot give investment advice to hundreds and hundreds of people I've never met, but hopefully that's helpful for you. And for the listeners, I put together a free PDF resource for you about what issues you should consider when reviewing your investments. And you can find a link to that in the show notes. Along with this episode, that should be a helpful tool for you to take a look at what's under the hood in your investment accounts and see if you need to be making improvements, adjustments, or anything like that. And if you're feeling overwhelmed, if you're not sure where these opportunities for improvement are or what to make of all the investments in your different accounts, I'll throw a link in the show notes and you can pick out a time to schedule a short, no pressure introductory we call it. We can talk about what's on your mind financially, and we can share how I help optometrists and practice owners navigate those same decisions all over the country. And with that, appreciate your time. We'll catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.